Good morning, good afternoon. My name is Richard Garland. I'm based in New York. I'm responsible for our global advisor business and also our institutional business in Latin America. And I'm joined, as we are every quarter, by Clyde Rossouw, who is the portfolio manager of the global franchise strategy. So on this call today, we have clients from all around the world, particularly South Africa. Clyde, as you may recall, is based in an office in Cape Town. So we have clients from South Africa, the UK, Europe, US, Canada, and also Latin America, and some people who stayed up late in Asia. So it's very much a global call to give an update on the global franchise strategy for both our institutional and our advisor clients. So as always, please ask questions at any time, and we will get to them sometimes during the prepared remarks, but also at the end. Our goal is to finish this update within 30 minutes. So within 30 minutes, our goal is to cover everything that we think is important for you and your clients to know. So I'm going to start off talking about our quality platform, and then I'm going to have a conversation with Clyde about where we see quality today, how the portfolio is positioned. So let's start off and look very much at our quality platform. And as you can see here, the key point on this slide is, whilst Clyde is based in Cape Town, whilst the global franchise strategy started over 14 years ago with Clyde managing it, it is very much a global platform. And we manage both UK quality strategies, obviously global quality strategies, as well as Asia Pacific and American quality strategies. So we have a complete suite of quality strategies, total assets, as you can see, 28 billion. Our global franchise strategy is actually now our largest single strategy at 91. So it's incredibly important for who we are and also for our clients. But the point on this slide, you can also see, as I said, global platform, portfolio managers, analysts based in London, Cape Town, and also in New York. So if we then look at the actual global franchise strategy and just highlight the key points on it, to remind you, it is a high conviction strategy with only 28 holdings, a high active share, as you can see, of 93%. So the point about this, it doesn't look like the benchmark, the MSCI ACWI. So if you've got clients who have a passive allocation, this strategy is the perfect complement to any passive allocation to global equities. And the performance that Clyde and the team have achieved has been done with a very low beta of only 0.73. So what I think many of you have recognized in this strategy over the years is we give you that outperformance, but the most important thing is it's done with smaller drawdowns in the down markets. And markets have been very interesting, as we all know, in the last 12 months. So I'm going to now have a quick chat with Clyde. I'm going to sort of preempt some of the questions that we've been getting from clients, and really just start off really with what you think, Clyde, about the outlook for quality and the cyclical recovery, because you've probably seen the same research that our clients have seen, which is very much that now seems to be, or they're saying that investors should look to allocate more to quality now than historically, because maybe, the word maybe, the cyclical recovery has maybe halted or come to a stop. So what is your view about, is now the right time for quality? And what is your view on where we are in terms of the cyclical recovery?
Yes, thanks, Richard, and good morning and good afternoon to everybody, wherever you are. I think it's important that, it's a very important question that you're asking, Richard, and in fact, the timing is also very, very, very opportune. We started, this is the third of the seminars we've done since the onset of COVID. We did one in April, which was just after the market bottomed. That was April 2020. We did one earlier in February this year, which was probably around about the peak of the 10-year cycle and also the peak of the rally of cyclicals and value in particular compared to the broader market. And it's important that we're having this discussion, here we are in the sort of the second week of July. And the reason why it's important is because we've seen some significant changes in the structure of the markets. Obviously, firstly, there's a lot of evidence to suggest that the second quarter of 2021, in other words, the June that's just passed, is actually going to mark the peak of the current cycle. And therefore, the pertinent question that investors are asking is, as we go into the second half of this year, are we going to see a deceleration? Is this a bad time for equities, or does this mean we need to change what we actually own within the portfolios? And it's very much our view that even although bond yields have rallied quite materially, and typically you've got asset allocations asking the question whether this is the start of the switch back from equities to bonds. We also have a lot of sector strategists arguing for stylistic shifts in their portfolios from value back into growth. And the way we would see it, and we're also dealing with a situation where inflation in the US is printed well above 5%. So it's a bit of a strange investment world that we're dealing with. But our view very clearly is that the markets are forward-looking. And in our view, the way in which the markets are shifting now, you do need to want to back the structural growers. And at the margin, we think that some of the profitability of some of the deeper cyclicals, banks, energy, might be very close to a peak, in which case some caution would be warranted in those sectors.
And actually, if we look at this slide, it's very interesting to show you to basically illustrate what you've been talking about. So I think any other points you want to make for this slide? I think it kind of really echoes what you were saying.
Yeah, absolutely. I mean, I think, particularly on the right-hand side of the slide, we're showing inflation expectations. And this has been critical to the success of the trade into value and cyclical stocks. And the assertion typically goes along the lines of, well, when the economies are recovering, there's a lot of broad pricing power, and businesses across the board will be doing a lot better. And therefore, you don't need to own exclusive, a small list of companies that are growth advantaged and brand advantaged. Whereas if pricing power is peaking, and that would be go hand in hand with inflation expectations peaking, then clearly that thesis is going to be called into question. And we think that investors should be thinking about that in terms of the next stage of the investment cycle.
Clearly, there's been concerns about COVID, and obviously that to some extent you've got, I live in America, and obviously in the UK and South Africa, we all know the troubles we're facing with the Delta variant. So what are your thoughts about this cyclical recovery, and to what extent, the further outbreaks of COVID could slow it down further?
Well, clearly there's quite the government policy response is going to be a function of the vaccination status that countries are achieving. I think it's fair to say that is one thing that we can sort of point to at this stage. And Richard, as you correctly pointed out, I mean, there are countries of varying stages of their vaccination status, and some countries have been more successful than others. And I think that also speaks probably to something of the resourcing advantage that some countries enjoy over others. And therefore, this idea that we'll have a synchronized recovery is going to be somewhat elusive. And certainly to our mind, in addition to an uneven technological advance, which we are seeing across the globe, you also will have an uneven government policy response, which of course is going to complicate investment decision-making even further. And I think it's fair to say that some of the more locally focused businesses in certain economies where vaccination rates are low and infection rates, you're seeing a third wave and perhaps even a fourth wave, some of those economies are going to be quite challenged.
Okay, that makes perfect sense. So when we look at the backdrop is a bit uneven, as you said, and one could say, as you said, the quality type companies you invest in are really primed for some resurgence because they've got pricing power on their side. So then the question is, how has the strategy fared over the last 3 and 6 months? And I think this slide is a fascinating slide, looking at, obviously, we know the recovery from when we have the value run at the beginning of the year, but I think the slide on the right is also very interesting, because the questions we always get from clients is, do I stay with growth? Do I come out of growth and go to value? And obviously our response always is, you go to quality. But I think it'd be kind of interesting for you to give your perspective on that as well.
Yeah, well, certainly, I think it's important again to recognize that lower long-term interest rates are incredibly important for businesses that have long duration earnings, and these are companies that will be able to grow on a secular basis for a number of years. And it's interesting, if you look at the left-hand side of the slide, you will see that the peak underperformance of our strategy versus the market actually coincided with the start of the January reporting season, so December year end. And here we are kicking off another earnings season. And by and large, we think that the corporate earnings profile and delivery within the next couple of days, we've got more than 50% of our portfolio's names reporting their results within the next 2 weeks. So the next 2 weeks is absolutely critical to the next evolution of performance. But you can see from the slide that when the market focuses back on earnings, the businesses we own are actually coming through quite strongly. And on the right-hand side, it's interesting. Don't want to make any particular points for or against other stylistic investments, but it's interesting that the performance of our portfolio does not sort of ride on the coattails necessarily of growth in particular. And where growth suffered very, very strongly in the middle of February, we didn't participate all the way in that downturn. And when the markets recovered, there's definitely a smoother ride that comes from the portfolio holdings that we have. And ultimately, that's one of the goals we are trying to achieve, is to invest in businesses that have really good characteristics, good credentials, perhaps differentiated, and are not always the names that are right at the top of people's minds when they think about global stock investing.
So if we look at actually the performance, obviously here's the long-term performance, but we can also focus on the last 3 months. I mean, as you showed in the previous slide, the strategy now has very much, it's outperforming the MSCI ACWI now year to date, but obviously had a very strong last 3 months.
Yeah, absolutely. I think, again, I mean, it's really encouraging for me. I look at performances, and there are a lot of numbers on the slide, so I'm not going to talk to all of them. But I think for me, the key points are, we outperformed during 2020, even though we lost momentum towards the end of the year. We were a little bit behind the beginning of February this year, and we've clawed our way back. And so far, year to date, not only is the performance ahead of the market, what's more pleasing for me is that our investors have enjoyed either low or mid double-digit returns, depending on what currency they're measuring those returns in. And that for me is the most important and telling point of a successful investment strategy. It's, are you actually making money, and are you making money relative to your alternatives? And unfortunately, we can put a tick next to both those boxes now.
I think it's very interesting to look at, in the last quarter, where the performance came from. And this slide obviously has a lot of information, but I think it would be helpful to really hone in on what drove that outperformance in the last quarter.
Yeah, again, I mean, if you look at some of our key investments we've made, Moody's on the rating agency side is one of our key financial stocks we've owned for more than 5 years. And whilst it does have a degree of market sensitivity by virtue of the fact that it does operate in the financial ecosystem, the performance has been incredibly strong in the last 3 months. And if you go back over the last 5 years, it is one of those secular winners that is just going to win. And unlike perhaps some of the banks in the marketplaces that are, the performance is absolutely critically tied to either the level of interest rates or the term structure or the shape of the yield curve. And if you look at the dynamics that are playing out there, both in Europe and in the US, it is quite a challenging suite of macro factors for most banks to deal with. So we're not sort of beholden to that. And then if you look at ASML, which has been one of our biggest technology weights within the business, this near monopoly in lithography. They actually reported their results this morning, and once again, very, very strong numbers. They've actually guided up their order book for 2022, 2023. And because of the long delivery lead times and the near monopoly state of this business, there's great visibility. So there's some businesses that, despite the fact they've done well in the last 3 months, we're pretty confident that the growth will be there. And just as a matter of point, I mean, ASML is a business that has grown its earnings by more than 40% in the last 12 months, and that's not coming off a depressed COVID base. This is off a strong base. So there are still businesses that have very good growth dynamics, but more importantly, prospectively still have a very, very strong revenue and earnings pipeline, which I think is important for investors to bear in mind.
It's interesting when you look at the sector allocation in terms of attribution, how financials has led the way, even though obviously you don't own banks, but it is kind of interesting, isn't it?
Yeah, it is, and again that proves it makes a very, very strong point that there are advantaged financials that still have, high quality characteristics, and again are less sensitive, to all of the machinations around monetary policy and second guessing what the Fed and the other central banks are going to do or not do with regards to interest rates. And there's no doubt that the environment, as I said, it's tricky and tough for a large number of historically well-positioned banks where they're struggling to deal with fintech innovation, struggling to deal with differentiated business models, and we don't want to be invested in those businesses that have had their best times behind them. We want to invest in companies where the valuations are reasonable, and importantly, as I said, the positioning in the marketplace is attractive, and we are finding those businesses currently in this environment.
So I've got a question coming in, and you probably can guess what it's about, because they've obviously looked at this chart, and for clients who obviously follow this strategy closely, they'll know that Booking is still in our top 10. So the question is, what are your thoughts about Booking?
Yeah, certainly. If you look at our portfolios across the board, first important point to make is that the MSCI equity is probably about 60% exposed to cyclical companies. So those are companies that do require a strong economic cycle in order to perform, whereas the actual cyclical exposure within the franchise portfolio is approximately 15%. So there you can see our relatively small bias. And of that 15%, it's fair to say that Booking makes up more than 4% of the 15. So it is a chunky allocation. Clearly, if you look at the outlook for the travel industry, it has taken a step down. But I'd like to highlight to people that prospectively, this is a business that in its online in the online travel agency space will continue to take market share. And one thing we have seen recover is regional travel has recovered. The US obviously leading the charge on that front. And we do know that there's significant pent-up demand for travel activity and bookings to be made for leisure purposes and obviously for corporate purposes. So whilst we don't think we're going to see anything near the highs, and we don't think we need to see those highs in order to justify the investment case for the company today, it does represent something of an opportunity on that front. But our portfolio is not exclusively positioned for that recovery, and there are a lot of other businesses which counterbalance that. So if you look at Nestle or J&J, which also reported today, we've got some highly defensive businesses that are on the opposite end of that spectrum, which balances out that exposure. So we don't think we're taking risk, if that's at the heart of the question.
So I think what's important now is to really look again at what you focus on as you pick quality companies, and maybe also address the current valuations as well, and also how purist you are in your approach to quality. So this is a slide that obviously you use all the time, but I think it's so interesting to look at, particularly on the leverage side, and also all these metrics are still intact, aren't they?
Yeah, absolutely. The businesses we own all have a phenomenal brand value, incredible cash flows, strong business models. So they've got interesting businesses, good products and services, structural demand for their products, but also attached to that, they don't just have great brands, they also have attractive financial footprints. And this is exactly what you are highlighting, Richard, on the slide. The quality of profits is very high. Typically the average business that you can invest in the world out there, converts about $1 of earnings is only about 80, if you're lucky, 80 cents of free cash flow. Whereas for us, in our portfolio, $1 of earnings is $1 of free cash flow. So that's already tells you something about the quality of the profits we have. This is not a growth disadvantaged portfolio. So if you look at the structural growth rates that are being delivered, it's double digits. And in fact, we've been able to improve that growth trajectory in the recent past. And again, if you look at the growth of earnings, we're measuring free cash flow growth on the slide rather than EPS growth. We know EPS growth can be manipulated in a number of different ways, most notably being borrowing and leveraging up the balance sheet to do so. Whereas if you look at the portfolio level, we still have no net debt, and in fact, on a sort of aggregate portfolio level, the portfolio is net cash. So they haven't sort of borrowed from the future to support earnings in the short term, and that gives us, or certainly me as an investor, a great degree of financial security. And then lastly, the quality of the businesses. We're big believers in companies that can deliver high returns on capital and deliver those consistently, and that's ultimately what underlines a great quality portfolio. And you can see that the differential there is still very, very strong and positive versus the market. And not a lot of portfolios out there, can truly say that they've delivered consistently on these characteristics over time. And I think that's quite important for investors.
And then the question always comes up, and this, is what about valuation levels? And historically, we know that you paid a premium for quality. There was certainly a period, we know, 3 or 4 months ago, where there was a phenomenal relative value trade with quality. So what do you think about the valuation levels of the portfolio at the moment?
Yeah, look, we know that equity markets are hardly depressed across the board. We know we've had a relatively strong run over time, and typically, again, most people who believe in mean reverting characteristics of valuation levels for markets will point out that the market levels are higher than normal on some defined metric, whether it's price to book, price earnings, or free cash flow, and we accept all of that. But again, I mean, the point you made, Richard, is extremely important here, and that is that a point-in-time valuation tells you nothing about the longer-term ability of a business or a portfolio to grow. And if we are confident that the business we own today are able to grow their earnings of free cash flows at double digits for the next 3 to 4 years, it's very difficult for us to see how that is not going to translate into a favorable investment return, particularly when you compare that against the typical other stock that you can invest in, or more pertinently, what you could invest in the fixed income space. Would you rather own US Treasury at 1.2% yield on the 10-year basis, or European yields close to zero? I mean, I know what I would rather own. And again, because these businesses have flexibility around their pricing structures and are growth advantaged, they should be able to do okay. We're not going to say that these businesses are they're pretty attractively priced compared to the average stock, but because of their high quality characteristics and growth advantage they have, we think they'll outperform, and they don't need to re-rate in order to do so.
It's kind of, we get a lot of questions about your style. I mean, the quality approach, and we compete obviously against many other global equity managers. And I think this slide's important because it shows that maybe there may be more attractive opportunities in different styles, but you're staying true to quality. I mean, because this, by the way, just to explain this chart, this shows 15 other global equity managers and their allocation or their investment style line against quality. And we're obviously the green line at the top.
Yeah, and again, I mean, the quality factors here are either returns on equity, returns on invested capital. So typically, those are the kind of metrics that we highlighted here. And again, the point is well made that there's a spaghetti list of other funds where the quality characteristics might differ from time to time, from cycle to cycle, and from market circumstance to market circumstance. And we've been telling the same story around quality, which we appreciate has been less understood in certain regions around the world, but we certainly think that it is a differentiator, and that's something that we will continue to firmly position our portfolios according to, and because of those characteristics that they will bear out in time to come, and that's. So when investors buy into the strategy, they should know what they're getting. We will evolve the portfolios, we'll evolve the holdings, we'll change the stocks, and we won't sit with the same 30 stocks forever. We'll evolve as we need to, but the characteristics that we seek are not going to change.
Okay. So I think that obviously people always want to know what's in the top 10, even though you say, well, it doesn't change that much, but I think it's great to obviously talk about it. And we all know it's a very concentrated portfolio. But then why don't we, if you can make a couple of points, maybe you covered a lot of this already, but obviously covered bookings and ASML and Moody's, maybe give a comment on Microsoft or Estee Lauder, and then let's look at what the changes have been to the portfolio in the last quarter.
Yeah, certainly. I mean, look, some of our key stocks are still our key stocks. We we're delighted by the fact that we've seen a very strong performance from Visa. Visa often is one of the stocks we get asked the most questions on because, one, people say it's so well known, but at the same time, it's one of those stocks where people continue to fret about the blockchain disruption, alternative payment platforms, and it might interest people to know, just on the subject of blockchain, for example, Visa has invested heavily in their own blockchain technology. They don't happen to have a Bitcoin with a $30,000 price tag attached to it, but they have invested heavily in the technology and they know how to use it. But blockchain is still not the ability to clear a ledger. The speeds are not fast enough that you can actually make it commercially viable yet. And that's not because Visa doesn't have the technology, it's just because the technology has not yet advanced. I think in the next 5 to 10 years, some of these alternative payment platforms might become credible, but by then we would have had quite a big washout in cryptocurrencies. So we like Visa because it's well positioned, it's taking market share, there's a recovery from a cyclical position, and the structural growth in card payments versus cash continues unabatedly. Microsoft has been a great servant of the portfolios over the years. It plays into a number of different themes. Clearly the digitization of the office, mobile office, we're all using Teams these days, is part and parcel of that. If you look at the technology advancements we've made and what we can do now in an online world, even although we're not engaging physically, I mean, that's brilliant. The cloud hosting capabilities of Microsoft is stellar, and the growth rate is still very strong. So we like the business, but we do accept that it has re-rated somewhat, which is why the positioning of the portfolio is lower. Microsoft used to be a 10% weighting and is now down to a 5% weighting in the portfolio. So that kind of reflects we're happy to harvest a capital on a position when it's done well, but it's still chunky allocation in our portfolios. Estee Lauder, again, I mean, we one of the secular themes we think is not going to go away is this desire for people to look younger, and investing in their skin is definitely right up top there. What better than a business like Este that leads the premium skincare market and has an incredible footprint both online and offline, and is well plugged into capitalizing on that trend. And whether people are going to be going into the office wearing makeup or not, we accept that is one area where Este has been struggling a little bit. But makeup will make a comeback, and even if it doesn't, we don't think it's that necessary in order to formulate a very strong investment case for Este. So well positioned on that front to capitalize.
Let's have a look at what the changes to the portfolio in the last quarter. Alibaba, we discussed at length on the last call. You remember that? That's kind of interesting what you see with Charles Schwab as well. That's kind of interesting on that one.
Yeah, look, I mean, I think it's important maybe just at this juncture to make a few quick comments on Chinese technology, because we know that it has been a source of some concern for investors. Certainly this year, we've seen a lot of noise on the policy level around clamping down on different businesses, the ability to expand. Alibaba's paid a fine, Tencent's been forced to pay fines. There's a lot of moving parts to the regulation story in China. I think what's important for investors to bear in mind is that whilst all of this is going on, and the regulator is very clearly has certain objectives that it's trying to reach, and it's also trying to curb some of the power. I don't think that the Chinese regulator wants to kill off the national assets and some of these best businesses. And what we've now seen, fortunately, in the marketplace is that the valuations of those companies reflect quite a bit of the regulatory uncertainty, and therefore offer an attractive risk reward, even for global investors such as ourselves, who've not been big investors in that part of the market up until now. So we think that's an attractive space. To your point around Alibaba, we spoke about that extensively in February about the purchase. They report next week. We will see just how strong the results have been. We don't think there's a change to the business model. There are some challenges in some of the e-commerce with some of the other smaller players, accepting lower gross margins. But again, I mean, in a world where we're funding at zero rates and raising capital at zero rates is changing, we don't think it's going to go on forever. On the Schwab side, Schwab is a business we've owned. We bought it when rates were low. It is a fantastic savings platform. It ultimately makes 65% of its money through the money market, and then the fees, and then obviously encouraging people to trade off the cash balance they have in a variety of different accounts, in a variety of different individual instruments, and also funds. and it continues to grow its client base over time. So very well positioned, but a little bit more sensitive to the rate environment. And we've just taken some money off the table because we think, as I said, that the environment is a little bit less robust from an interest rate perspective, and we've reduced the exposure, but we still have a weighting in Schwab. We haven't sold it to zero.
Okay. So I think let's wrap this up by looking at where we are in terms of the historical alpha cycle for the global franchise strategy going back to 2007. And this is a perfect chart, isn't it, with the bubble in the right place. But to me, maybe talk about where we are in that cycle, and to what extent you feel confident that you're going to rise back to where you have been historically in terms of the outperformance.
Yeah, absolutely. Again, the important point when people think about and reflect on some of the 1 and 3 and 5 year performance numbers, it's important to recognize that when you look at the 1 year performance numbers and the 5 year performance numbers, you're measuring performance from one of those red circles to the green circles. And therefore, it is obviously creates a very interesting base effect from that perspective. We're confident that what we do will ultimately deliver an increasing outperformance of markets over time, as this chart has suggested. And as we'd highlighted earlier, in February, we had one of those trough points within the bubble chart, and we certainly are starting to see the market conditions shift more favorably in the favor of our stock. So we will continue to make sure that the businesses we own have the earnings characteristics, the strength of business model, in order to be able to perform in those circumstances. And as such, clearly what markets will do in absolute terms is always a little bit of a guess. We know there are a lot of headwinds. There are also tailwinds for the markets. Headwinds being regulation of big tech, tailwinds clearly being a benign rate environment, probably for quite some time, ample liquidity. And therefore, we can still think that this is an environment where investors should be, continue to look to stay invested rather than capitulate and seek alternatives. And as our performance recovers, we're confident that investors will be rewarded on that front.
So really, what we're saying is that now is a great time to allocate to quality. And you've laid out that nothing's changed in your process. And I think I want to end on this slide here, which I think is always so important for clients to remember, is that what Clyde has created with his team is a strategy that particularly I want to draw your attention to the right-hand side of this chart, which shows how well you've held up in tough markets. I thought it was so interesting when you showed that chart at the beginning, showing the 6-month performance against growth and value, and how growth had that sell-off in February, and how the franchise strategy held up. So I think this is obviously a great way of thinking about the strategy. We'll give you the close to the market performance in really strong markets, but where we'll really add alpha is clearly if markets have a tough time.
Yeah, I mean, people have different views around the market outlook, and I think that's it's not our role to sort of tell people what they should expect from the broader market circumstances. But to your point, whatever your outlook is for broader equity markets, hopefully it'll give investors some degree of comfort in knowing what kind of performance trajectory we're looking to achieve, and this performance trajectory, is irrespective of the change we made in the portfolios over the course of the last 14 or 15 years. Because again, if the characteristics are the same, the built-in risk parameters are the same, the low leverage is the same, and the quality characteristics are there, the performance footprint will be very similar, and if anything better, because we're looking to positively evolve the portfolio as the team of analysts that I work with find more and more investment ideas, and that actually is quite an exciting journey for us still.
Awesome. Well, Clyde, we've covered all the key points. I mean, what we do with this quarterly call is we canvass our clients to make sure we address any concerns or questions they have. So I think we've done that. We've tried to keep it to 30 minutes. So hopefully that was short enough and informative enough. So Clyde, thank you very much for providing insights into the global franchise strategy. To everyone, please contact your relevant salesperson or client service person at 91 if you want any more information on the global franchise strategy. And we'll see you in 3 months' time. So Clyde, thank you very much.
Thank you, Richard.